Hello and welcome. This is the Insurance Pro Blog Podcast. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
That's right.
Favorite podcast about life insurance this week. Next week, we'll see. We'll see. What does that mean? It can mean a lot of things. Let's not dig too deeply into that one. Oh.
We used to say the internet's favorite website about life insurance, but it seems that most people have forgotten there are websites out there.
That is the way the world works.
Yeah.
It's all on YouTube now. Where we should be, and we kind of are, but not as much as we could be. But that's
it's really hard to
day.
compete with cat videos.
It is indeed. Are you telling me I should get a cat and do the videos with a cat?
Well, you already have a cat.
Yeah, so. I know. But we don't need to talk about that. We're here talking about life insurance.
I've seen the Christmas card. I've seen the proof. There's a cat. Two cats, as a matter of fact.
This is true.
Your children.
You have no idea how much time goes into selecting what the right picture of cat is for the Christmas card.
All right. Well,
I'm just going to say that. We're going to move on. Hey, got a statistic for you.
Okay.
40% of the current financial professional workforce plans to retire in the next 10 years.
I are not one of those 40%, but yes.
Well, then I guess we don't have to worry about it because Brantley will still be here for you, and we'll see you next week, folks.
That's right. I'm just hoping in the next 10 years that the 40% of people who currently work with someone and aren't working with someone will come and work with us. So, we're just going to, that's been our plan from day one. Just be there.
Yeah. Just hang out. Once everybody's dead, here. We'll still be here. Yep.
Be here 25 years later and everything will work out just fine. If you're a new agent and you're listening, that's our advice.
Yeah. Life really begins at 65.
That's right. All those things you think are going to work, they're not. Just hang out. Be cool. Yeah. It'll work out eventually, maybe.
With nearly half of the people, and we're saying financial professionals, so not financial advisors per se. They're in the group.
Yeah,
but
sure.
Everybody who's in the business of trying to dispense some sort of financial help.
There you
go. Be
it
through transactions or through advice, whatever it is.
Right.
40% of that workforce right now says 10 years from now I'm done. And we know from the statistics that it's an aging population of professionals.
Yeah.
So
I would say anecdotal, but I've been to a lot of meetings.
Yeah.
So, I mean, at this point, I feel like I've reached statistical significance because I've been to so
you've gathered enough data. You've gathered enough data
and I don't mean one-on-one meetings. I mean large conferences and that sort of thing. Yep. And I'm currently 48, and I still find myself not the youngest person in the room anymore, but amongst the youngest 10% in the room.
Yep. Yeah.
And I've been saying that, but you and I have been saying that for a long time. Like,
yeah, like the older we get, it doesn't seem like the more we shift in terms of the percentage breakdown of age demographic whenever we go to these things.
Yeah.
So it is
the
intriguing.
Same people.
And
it's
if
just
I think
a lot
about,
of them are in their 70s or early 80s now.
Yep.
As opposed to, when I first met them, they were in their 50s.
Yep. And if I think about the last time you and I were together at a conference, there were 30, 40 people in that room.
Yeah,
it wasn't a big one.
Probably.
I would reckon we were some of the youngest.
Yeah. Yep.
So
I don't think you're making that up.
It is strange. And so I can't remember where this statistic came from, but I have it in the notes here. It might have been somebody like the Boston Group or McKinsey figured this out, that there is like this super high risk that your typical mass affluent and above American has a crazy high risk of outliving their financial advisor's career or their financial advisor period, the end, if they didn't decide to never retire.
Yeah.
There are a lot of people.
Oh, go ahead.
There are a lot of people who are relying on the guidance of somebody who is very near retirement age and or very nearing the end of life.
Right.
And they're not near as close to either of those two markers themselves.
Right. I've had a handful of conversations over the last couple of weeks with, I mean, it's eerie that you brought this up as something we should discuss. These are personal experiences that have happened to me in the last couple of weeks. I've had conversations with people who said, I worked with an advisor. He was great. I loved him. And he retired and sold and either sold his practice or recommended that I go work with, some version of that.
Yep.
Go work with this other person. And then that person retired. And so they're now, on their third and or fourth advisor in the last 10 to 15 years.
Mm-hmm.
So I'm saying if it's happening to me,
yeah,
in a very small sample size, it has to be happening a lot more than you and I were aware of.
Right. We always kind of intuitively, we always theorized that this was going to be an issue.
Right.
And now, even more than before, we're starting to see it play out.
Yes. And it's not, in the insurance, let's silo this conversation for a second. I know we're talking about financial professionals broadly speaking, but let's silo it to the life insurance world.
Okay.
Because we're the Insurance Pro Blog podcast. There is no mechanism in most cases, I would say 95+% cases, where a life insurance agent sells, quote unquote, sells their practice to someone else. There's nothing to sell.
No, not really.
So you get what I'm saying? Like if someone, has an HVAC contractor or company that they've worked with for their home for the past 20, 25, 30 years, whatever, and that company, the owner decides to retire, they sell to someone else who takes over all of those service contracts, et cetera, et cetera. There's a seamless transition, so to speak. That doesn't exist in the life insurance world.
No. There is. We earn a very small amount on the business that still has a paid premium going on. Like
right.
if a policy is paid up or somebody's not paying anything, there's nothing that we traditionally get for those.
Right.
And so there is this whole concept of the renewal payment to us. And I'm not going to say it's an insignificant amount of money that comes in, but in general, it's not a very large sum that entices somebody to pay you any size of money to take that over. And it certainly doesn't give them an incentive to acquire those clients, because acquiring them brings about the time liability of having to provide service for them.
Right. And in most cases, as an independent agent, the revenue stream dwindles.
Yeah.
Over time.
If you don't
on a per client basis, I should say that.
Right.
That should be clear. In other words, a lot of people have this idea, the general public has this idea that insurance agents, after 20 years, they're on easy street, because most people call them residuals. We call them renewals because that's what they are.
Nah, it's because we made so much money selling all that horrible insurance that we put it in the real things that make you money and live a great life, right?
Yeah.
Sarcasm lights on for the people who don't pick up on that.
I would say Uncle Sam's doing far better than I am off of the income that I've earned over the years.
But the one piece of good news about life insurance products, if you buy one, is the need for a lot of management is somewhat less in a lot of cases.
Yes. Yeah.
So
there's no day-to-day management that's required per se.
Yeah. And when it comes to life insurance or annuities, if you're doing it for the sake of like future income,
Yeah.
So I want to buy the annuity because of the guaranteed income piece, or I want to buy the life insurance, whole life insurance, universal life insurance, whichever one, because I want to use that as another piece to the retirement income puzzle. And there's a little bit of nuance to that, getting used to it when it starts.
Yeah.
But in general, there's kind of an automation that takes place. And because of the super stability of year-over-year returns on life insurance cash values, there's not a lot of risk.
Right.
Provided that you don't deviate far from where you started income-wise to upsetting things and needing a lot of hand-holding. There's far more things that can go bump in the night when you are building a stock or even bond, primarily through bond fund portfolio, that's going to require a professional to help, or you're going to have to roll up your sleeves and take a very, very strong initiative to sort things out from a DIY perspective.
Right.
I'm not
There's
saying
going to be more need for intervention.
Yeah. And look, you can do that with stocks and bonds, and you could do that with life insurance. You can come to understand what you got to do.
Yeah.
But most people aren't going to do that. And so there's a whole lot more need for the advisor when it comes to the individual who's relying solely on things like stocks and bonds to manage the portfolio from an income capability perspective.
Right.
I'm not saying you can't figure it out. I'm just saying that a lot of people don't want to do that, or there's something that's going to stop them from doing that.
Right.
So one of the issues with having your advisor or your financial person, if it's not an advisor, retire or die is the possibility that it might happen at a point in your life when you're getting a little older.
Mm-hmm.
And your ability to process information isn't what it once was.
Right.
And your possible making an error has increased to some degree.
Mm-hmm.
And these are all things that are a source of anxiety for retail investors. And you can try to mitigate some of this by purchasing investments that are very income focused. Maybe it's just a dividend paying stock, or maybe it's some sort of fund that has consistently paid distributions of some sort for a long time. That's a little bit of a hedge, but a lot of those things can be a little variable in terms of the income that they produce, and they can certainly be volatile in terms of the per share price.
Yeah, for sure.
And there are times that guidance from a professional is mighty helpful. Life insurance, on the other hand, isn't going to deal with a whole lot of volatility in that regard. If it's an annuity, it'll deal with none because the income stream is guaranteed. If it's life insurance, whole life insurance or universal life insurance, there could be some variability, but for the most part, it's been our experience that even a change in dividend or a change in cap rate on an indexed universal life insurance policy doesn't move the reality of future earnings around enough to upset the income stream once it starts.
Right. Yeah,
so,
very true. The exception would be some company, something that happens on a company level that changes the way things are done.
So if you owned a whole life policy from a certain company from Ohio and you were using it for income,
I thought of that as a caveat, because those things are rare, but they do happen.
But here's the important thing to differentiate there. It wouldn't matter if you had an agent or not.
No.
Because they're not going to be able to undo what's going on in that case.
No.
So the issue that the industry, and I'm talking finance, insurance, the whole thing all rolled up into one, is struggling with is how to handle the transition. And in the world of like investment advisory, where you have an advisor who basically invests at his or her discretion on your behalf. So you've kind of handed over the reins, and that person manages the portfolio to produce some result that you're looking for. That segment of the industry has basically decided, well, there is a value in the quote unquote book of business, the list of clients and the assets that are managed, and therefore the fee that is charged against those assets. So anybody who's in that business could decide, I don't want to do this anymore. And I can find somebody who wants to do this, who wants to acquire these clients, because they're going to take all of that money. They're going to charge their fee against it, and they're just going to continue to do what I do.
Right.
Which is a more viable financial option than trying to acquire somebody's old book of insurance clients, because there's more money paid generally on the dollars
there's actual revenue that's produced. Yeah.
The problem is finding the person who's going to continue to do what the old advisor was doing.
Right.
Because many circumstances, anecdotal situations that people have voiced to us, things that we have observed from other people, other professionals in the industry, is it's very difficult in some cases to get somebody to acquire your list of clients and just carry on from there with the same thing.
Right. Yes. Because they're not, once they own it, they're under no obligation to carry on in the same manner.
Right. So the problem that the retail investor ends up in is, I really liked what was going on before, but now I'm not getting it at this point.
Right.
And maybe I try to do it myself. A minority, will piece that together.
Right.
Everyone else is left just trying to find another person who maybe can step in and do this. But if you are in a position where your retirement income plan is to let an individual manage your assets in a way that makes up, let's say, the majority of your income in retirement, that's not Social Security or a pension that maybe you have if you're old enough to be part of one, there is a certain amount of anxiety that those people face, in the sense of, well, if my person retires or just accidentally steps into the road while the bus is pulling through, how do I continue to get what this person is doing for me?
Mm-hmm.
Now, I'm gonna come down with a crushingly depressing statement here and tell you that ultimately there's very little you can do to 100% hedge that risk.
Right.
There's just very little you can do.
Sure.
If you are working with an advisor who is managing assets for you, or even you're working with a registered rep who has sold you a certain number of investments that are just working in a certain way for investment, but you're relying on them for some additional sort of peace of mind or guidance on why you're buying the things you're buying and things like that. If that person ceases to be in the business for whatever reason, that is going to cause a degree of risk now that your income could change because you don't have the eyeballs on the investments that you once did.
Mm-hmm.
Life insurance.
But I would argue that that's no different than any, you have your favorite coffee shop, and then one day they decide we're not in business anymore. So it I realize it's different when it's your money involved, but I think you're right. There's no 100% way to hedge that risk.
There's not. But one of the things that's unique about life insurance products is, if the agent ceases to exist, at least in the industry, as a person that you can speak to for guidance, you don't have near as much risk as the income failing.
Right.
Because you don't have to make adjustments to those things.
Right.
This is not by any means an effort to convince you that you need to fire your financial advisor and transfer your entire investment account into an annuity or life insurance. That is not what this is about. What we're trying to point out right now is that when you build an income plan, you should have a certain focus on things that build guaranteed or near guaranteed income.
Right.
And those are the things that you should cover with things like annuities or life insurance.
Right.
Now, if you are super risk averse, you could always go a little bit beyond that and cover some discretionary expenses with that. That's fine. Or if you happen to just favor a certain contribution to an indexed universal life insurance policy, and it produces income that is far above what you're just gotta absolutely make it income number is, oh, happy day. You've got some more stable income that you can use for discretionary things.
Right.
But that's where we should focus the use of life insurance and annuities, because there is a strong likelihood that you will grow more overall net worth with stock exposure.
Sure.
But there's also a risk that it doesn't work out as hoped, and or it creates significant revision in income that creates, at the very least, a substantial amount of anxiety for a while.
Yes. Yep, we've seen that before.
And anxiety has a weird way of causing other health issues as you age ramp up even faster.
Yep. And annuities and cash value life insurance, they're just simple and very stable, as you mentioned, and don't require lots of manual intervention along the way.
So to way oversimplify, which is not something we're used to doing, life insurance or annuities as part of the income plan removes some of the worry about what happens if the person who sold this to me is no longer around.
Right.
Because they work on a little more automation. Again, annuities, they have a feature. You can turn the income on and you receive the income regardless of what happens to the annuity contract cash value.
Mm-hmm.
Life insurance
gets deposited to your bank account on the same day every month. So.
Yep. Life insurance is a little more variable, but there's a very solid year-over-year rate of return, and so you can start an income stream that is done automatically. You can fill out or establish an electronic funds transfer where the insurance company takes X amount of dollars from your cash value every single month and just sends it to you.
Yep.
And they can even do it as a withdrawal and or a loan.
Right.
So you can create a systematic income from the life insurance policy, and there's no need to request a withdrawal. And again, setting up at the beginning with a prudent figure, and we've talked a lot in the past, roughly 5% of whatever the cash value is for whole life insurance, could go up to about 6% if it's indexed universal life insurance. Starting at that number, there's very, 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 very low likelihood you'll ever have to worry about running out of money.
Right. Agreed.
And investments, on the other hand, there are things that can change.
Yep.
Market corrections might warrant a downward revision in the amount of income that you can take from the portfolio. If you're living more on distributions from assets that are more focused on income, that's a safer way to go about it, in my opinion. But there are a number of circumstances that may come up that cause those distributions to get cut.
Right.
So you might be used to collecting $5,000 a month from your investment portfolio. And then one day you log into your account and find out that the total of your distributions this month was $3,200.
Right.
Because distributions changed.
Yep.
And now, if you need to make up the difference, you'll have to sell some positions
in
order to raise the money. And which ones make the most sense to sell? Well, that depends on a lot of things. And it's very hard to give any sort of quick rule of thumb on that. And that's where advisors would absolutely come in. But on top of that, if you had an advisor, that person probably knows about the distribution cuts and is going to take action beforehand.
Right. To try to mitigate that.
Mm-hmm. Which is a great thing. It's why you should have one if you feel you need one. But if that person, again, retires or dies, that puts you in a weird situation where now you're going to have to find somebody else to do it or try to figure out how to do it on your own.
I would say with life insurance, income let's call them income distributions. They could be loans, withdrawals, combination of the two. Mm-hmm. The most care that has to be taken is when you set it up.
Yeah.
To get the number right.
Yeah.
To make sure it's not too high. But once it's going, it's going.
Yeah.
It can be revised, obviously, but
it can. And even without an agent, you can request an in-force projection on the policy.
Right.
Given what's currently going on. So you can literally contact customer service and say, listen, I just need an in-force illustration and assume everything that's going on right now. And if you have distributions taking place via EFT, that will be part of the assumption that gets made when they run that in-force ledger. So you can see, all right, will this, as it stands today, last for the rest of my conceivable life?
Right.
And that's a pretty easy thing to discern from an in-force illustration, even without any kind of formal insurance training.
Yep.
The other piece here that goes beyond just losing your advisor. You may work with an advisor completely. You may work with an advisor sort of. There's plenty of people out there who still like to control a little bit of management over a section of their money. So maybe the advisor has discretion over a part of my portfolio, and then I take care of the other piece.
Right.
When people have a tendency towards being a DIYer, it is much more common for one spouse to be the DIYer, not both.
Right. So
if you have an advisor,
one does the work and the other one complains about how poorly the one that does the work does the work.
So if you have an advisor, there's always a chance that you become incapacitated and all of the rest of the money is managed by the advisor.
Yeah.
But if you are a DIYer and your advisor passes away, you might decide, hey, I'm going to just take over this myself. But one of the things that we hear way more than half of the time when people approach us about annuities especially is, I have done a pretty good job, I think, managing a lot of my own investments. But if something happens to be me, there's no way my spouse is going to do this.
Right.
And the most important thing that I need to sort out right now in my life is how I could set things up to create income guaranteed for them so they don't have to try and learn any of this stuff, because it's going to be, it's a non-starter.
Yeah. Yep.
And
we've seen quite a few people move into annuities because of that.
Mm-hmm.
Not exclusively, but I'm just saying for a portion of their net worth, they go, yep, if my spouse had $5,000 a month or whatever the number is, they'd be fine.
Right. They don't have to manage the rest of the money too closely to take the probability of running out of money basically to zero.
Right. Exactly.
And there is nothing that needs to be done with the income piece of this anymore at that point.
Mm-hmm. Mm-hmm.
So it is true that life insurance and annuity products are kind of the ultimate longevity tool when it comes to retirement planning.
You mean insurance does a good job of insuring?
Yeah.
Come on.
It's weird how that works, right?
Yeah.
So as much as we can be a little on the negative about overall rate of return, certainly not products that are going to make you unbelievably wealthy just because you bought them, and unless you're already unbelievably wealthy. But they are going to bring substantial stability to the table, and they are designed to outlast your advisor, your cognitive capabilities, and possibly even you on the behalf of your spouse.
Right.
And that's why they deserve at least a consideration when it comes to your retirement income plan.
Yeah.
Because they can play a pivotal role in eliminating some of those risks.
Absolutely. I agree.
Anything else?
Nope.
Okay.
I think that's it. I think we covered it.
Good enough for this week. I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.